Hello, we're here to talk today about Lloyds Bank. The recent results have come out this morning, so I thought it would be a pertinent time to have a chat with Ravi and discuss his thoughts and see what the views are. So Ravi, the results out this morning?
Yep, Q3 interim management statement was out today. As usual with a lot of these banks, there's some things that are good, there's some things that are okay, there's some things that are not so good. I'll deal with them consecutively. I was impressed by the rise in the net interest margin at Lloyds, which zoomed up 24 basis points, 2.63%, which is a very high level relative to recent performance. So strong growth in interest margin. Tangible net assets was up a penny and a half to 55p, which narrows the premium at which Lloyds has traded for some time now against the peer group. The company also made progress on impairments. Impairments fell to just 2.1% of the balances. And total loan advances were only down 5%, which isn't bad when you consider that the company is now fully deconsolidated TSB. So TSB has left the picture, but the loan balances at Lloyds have only down 5% as a result. So those were the good things.
Okay. Share price hasn't taken that on board. I mean, it's down about 4.5% at the moment, trading at 73. I mean, the trading range has been pretty narrow for a while. I suppose most people would be interested to find out if and when this stock is going to break out of it. I mean, we have the public sale next year. Do we think once that's occurred, that will be when the stock can finally try and break out of this narrow trading range?
Well, my view on this is that obviously at the start of this year we had a trading plan in place that was put in place by the government to sell 1% of the stock every few weeks. The government has so far this year sold, gone from being a 25% holder to having gone just under, I think, 10%. So there have been frequent sales by the government of shares, which has meant that the stock, which started at I think around 76p, has basically been dead money this year and is now roughly the same level, a few pence below. So the stock hasn't gone far as the government has run down its interest. There have been a few issues this year with retail ring fencing recently that have caused a bit of concern. In terms of a breakout though, I think a breakout, given the premium to net assets, the company's a 20p premium to net assets, when most of the peer group are at large discounts still to net assets. So I'm hoping to see maybe a breakout as the earnings picture clarifies. This year we're still up for between 8 to 9p of earnings. That's sort of what's happened. Q3 I think it was 2.1 pence of earnings, if I got that right. 2.1 pence of earnings was announced today, so that's 8 to 9p. When we see earnings of north of 10p, I think there'll be room for, maybe £90 a share when it happens.
If we look at the sector as a whole, banking been probably one of the worst performing sectors on the index for the last several months. What's your view on the competition in terms of Metro Bank? Obviously, as you say, they've delisted Lloyds TSB. What's the environment looking like now for retail banks?
The fact that TSB is now in the hands of Santander, which is not Santander, Banco Sabadell, which is a large institution, that basically has increased the competitive environment, because TSB is no longer a small player, it's now in the arms of a large bank, so that could increase competition. Frankly, there's a lot of competition in mortgages already. The challenger banks are starting to increase market share. I would be concerned that maybe what the real issue is that the competitive environment will become more intense over the next 12 months, especially as interest rates start to rise and people start shopping around for moving the mortgage, moving their current account possibly, and more of the industry shifts online, which is a trend that's happened in the last decade. But certainly millennials and the younger generation are keener to bank online and to try smaller outfits relative to sort of middle-aged people and elderly people.
I mean, one of the statistics the regulator will be looking at is the Tier 1 capital. Just in case people aren't fully aware or understand what this means, I mean, this is something we keep an eye on.
That's right.
What's the Tier 1 capital like, and just to give people a basic understanding of what it actually means for the firm?
Well, Tier 1 is important. Tier 1 is the amount of equity capital that the bank is able to lose. That's the amount of capital that the company has that it has to sort of keep very close attention to. The Basel rules lay down capital requirements. The bank has to have a requisite capital. It has to have requisite buffer capital ahead of the minimum requirements. As Basel changes and the capital requirements change, banks have in recent years increased Tier 1 capital. So they've increased broadly their ability to absorb hits and losses. Going into the crisis a few years ago, the banks had highly levered balance sheets, often in the range of 20 to 30 times leverage, which meant their ability to absorb losses was greatly reduced. With higher capital levels, banks have more common equity and are more able to absorb losses.
Lloyds Tier 1 capital recent results?
Lloyds Tier 1, if we look at it now, is common equity Tier 1 ratio is 13.7%, which has moved up 0.9% in the course of the last, since New Year's Eve.
So we don't expect any people queuing around the block for Lloyds Bank in terms of a
we think
cash withdrawal.
Yeah, the capital levels are comfortable, and in recent years Lloyds has also increased its deposits and lowered its credit. So the amount of reliance Lloyds has on the interbank market is greatly reduced because loans and deposits are not far from each other. The bank is able to rely more on deposits, which are a cheap source of funding, as opposed to borrowing from other banks, which tends to be more expensive. So that's been a major impact as well since the crisis.
Okay, I think that covers Lloyds Bank off quite nicely. So thanks for that, Ravi.
Thank you. And bear in mind, we'll be following Lloyds in the run-up to the retail IPO. We've done a note already, and there will be further advice in the run-up to that IPO. If you click on the link at the end of this video, we'll take you right the way through to it. So please join our register, and you can hear more from me. Thank you.
Thank you.